So we talked about the number of commercial banks and how it actually changed within the last 70 years. And we've seen how, we went from 14,000 commercial banks down to little less than 5,000 institutions. And, this in a way happened because of consolidations and higher competition and a lot of the, institutions have failed. So we looked at how these failures were spread out through the years, and we have now increased number of banks, per decade. Notice, I think the biggest failure that we had, or biggest number of institutions that failed, was in 1980 to 1989, um, the advances in technology is putting the banks at greater cost and competitiveness. And it just, they need to set aside a lot more resources just to be able to survive against the national banks. And right now, we've seen on Monday's lecture that only a handful of banks now make up the majority of banking structure in the US. And this is not actually specific to the US. This is appears to be a global phenomenon. Many countries actually have only a few banks. And we now are going, even though we have about 5,000 institutions, we are still dominated. Our banking industry overall is dominated by a handful of larger institutions. So I wanted to show you this bank failures by FDIC, a little more official, and we go back to the past 20 years, and this actually shows the total assets with respect to the failures and the number of bank failures that we see. And notice that we actually had a significant jump within just, last couple of years. So, I think that one of them is Silicon Valley Bank. That was a large bank that makes the assets go up significantly higher. And for 2020 and after COVID, I think FDIC was very preemptive in their intervention into the banking requirements, and therefore we didn't have any banks that actually failed, or that would be considered as a failure. So, and we had significant number of institutions, commercial banks that failed after the 2007 crisis, and I'm going to talk about that today when we're talking about the financial innovation and shadow banking system. So, notice how the green line is your total assets, and the red line is your bank failures, and the left side is your total assets, and the right side is your number of bank failures. And even though only about 3 banks failed right here in 2007 and 8, this actually corresponds to a significant asset total of about $373 billion. And in 2010, we actually had 157 institutions that failed, and then subsequent years we had significant number of institutions fail. And these actually put FDIC at a significant obligation to maintain the integrity of the commercial banking system. So this is by Cleveland Fed consolidation within the banking industry. And there are some key findings that I want to talk about. We don't really talk about the banking failures all that much. I guess that's to complement how well the FDIC handles these failures. We don't really see on the news that the bank have failed and depositors lost money, and there's a significant upheaval, and I guess that's because most of the failures within our generation happened or ended up being acquired by larger banks. In the case of VAMU or Silicon Valley Bank or First Republic, we actually have banks like Bank of America or Chase being burdened by taking over these banks and their customers and their portfolios. and therefore, from a depositor's point of view, no one actually has to deal with any sort of insurance or any sort of legal proceedings. It's just business as usual. You actually go to a bank A one day, and then next day, just the tape, the um their name changes and their branches change, and they become Bank B. So from a creditor perspective, or from a credit client perspective, or a deposit holder perspective, we don't really see all that much of a change. And again, I think that's a compliment to FDIC and the deposit insurance all around the world. And it's the intended purpose of these deposit insurance schemes, so that there is no intervention or visible intervention by the government, and therefore, any sort of loss of confidence in the banking system. So while these are banking failures, we also do see significant number of banks merging or being acquired, and we refer to this as consolidation. So I guess one of the downsides of this is that when banks consolidate, they seem to close branches. There is no need to have multiple branches in the same neighborhood, so it's cost cutting. But if the banks are specialized in different regions of the country, obviously it becomes significantly more synergetic, and so that usually makes a little bit more sense. So from a Chase, for instance, perspective, when they took over assets of the Washington Mutual in the Western Coast, Chase had very few branches, if any, in the Western Coast, and it actually became very preferable for them. Same thing with Chase taking over Bank One about 2 decades ago in the in the South, and Chase had very few branches. And when they took over Bank One, they literally changed all the branches into Chase and continued as usual. But in the case of other more strategic consolidation, this table by Cleveland Fed actually shows the number of institutions and the number of branches. And notice that the average number of branches per institution is increasing. So that's a good thing. So, basically that, the banks, as we know them, are growing to become more customer-oriented institutions. However, in totality, while the number of branches have increased to 60 from 66,000 to 83 in 2020, I think that it's actually gone down a little bit because of the COVID. I think banks, and there's a report by NCRC, National Community Reinvestment Coalition, that actually argue that the COVID-19 was an opportunistic era for commercial banks to shave some of the unprofitable branches without looking bad. So before that, though, let's go back. So the Cleveland Fed findings that says that the number of banking institutions has declined since the 2000s, which kind of knew that this has happened. And this decline had accelerated during 2010, again, primarily after the 2007 crisis. The mortgage-backed security problems, the AIG insurance, failing, that kind of led quite a few banks to have or to lose the reliability of their credit portfolios, and therefore they had to fail. So, the number of institutions have declined over 2,300 in the past 2 decades, and most of it happening in the last decade. And they're also emphasizing how number of branches is declining. And, in a way, this is good for the banks, from a bank perspective, simply because they're cutting costs. But from our perspective as retail customers, this is not as good, because not every American lives in a big city, and for banks to have a branch in a big city is really not that big of a deal. they're more concerned about branches that they offer as service at perhaps more rural areas. Um, so, as a bank, you cannot just offer services where it is profitable for you, but you also have to offer full service, even for clients who are not in large cities. So, when the banks consolidate or they go into this cost cutting, um, you know, plans or schemes, um, but one of the obvious moves is for these banks to literally close branches that are not profitable. And from a retail perspective, from a client perspective, we lose the branch in our neighborhood. And as an example, I live in Mandeville, Louisiana, and before COVID, we actually had two Chase branches, one by Causeway, and the other one was towards the I-59. And they closed the one that's on Causeway, which was closer to me. Um, the inconvenience is not all that much. However, they did close one neighborhood branch, and it was the branch that I used to work with. And I made friends there for over the past couple of decades that I've been living here. And most of the people got reshuffled to other branches, but there were some that literally just got fired. And they not because they were not good at it, what they were doing, but they were considered to be an additional expense that did not justify their payroll, and therefore they were just fired. So again, we discussed how commercial banks are not charity institutions. They're not there to provide services for free. However, they also have a intrinsic place within our economy, within our community. And as the consolidation takes place, we seem to lose their sense of service for our communities. So when you look at the, what this organization calls as the Great Consolidation, we see that the COVID-19 was it was an opportunity. So when a bank starts to close branches, it might actually look bad, as if they're either withdrawing from a retail banking or from an area, um, or if they're not in as good of a financial standing as they were before. So it might be construed as a negative financial signal. So a lot of the times when a bank opens a branch, that branch usually stays there for a long period of time, unless they actually consolidate two branches and make it a bigger, beautiful branch and whatnot. But it's always a challenge to change a branch location or existence without sending a message to the community. And obviously, you don't want to lose clients to your competition. So banks are at a bind when they want to stave off a few branches and cut costs. So recently, for instance, HSBC pulled off almost completely from retail banking in the US, and they went to high net worth individuals for wealth management. And for them, this was a part of a strategic move, and therefore they didn't really have to justify anything with respect to finances. But if a regional bank or a local bank starts to close branches, I think the general perception would be that they're not doing well, and therefore they need to cut costs, and maybe I should get my money and put it in in an account with a national bank. So anyhow, so the COVID seems to be a significant advantage, and banks shave off branches, close them off, and simply blame COVID for it. And just as what happened, in Mandeville during COVID, the branches were closed anyways, and they simply, we went into COVID with two branches in Mandeville, and then we came out of the pandemic and we only had one. And I'm not sure if a lot of people noticed what happened. Um, so, it was an opportunity. However, um, this, this creates more of a strain on a lot of communities. As a retail, um, you know, client or a customer, um, my business is what your checking account, a savings account, a debit or a credit card, and this and that. But for businesses, they actually depend on these branches, not just for their location, but for the businesses, the credit that they offer, and the services that they're offering to the enhancement of these businesses, or the longevity or the existence of these individual businesses. So the community, not just from a personal banking perspective, but also from commercial banking perspective, depends on these branches and depends on these banks. Shaving them off during a pandemic is opportunistic, but we have seen it. And as you can see, with respect to the number of branches, this is what we have gone through. And then after COVID, we'll probably have data soon that will actually show that that the banks took this opportunity to close quite a few branches. So this is a chart that actually shows the total number of domestic branches. And notice how in 2000, we were around 80,000 branches. And there was what I would prefer to call this as a bubble, especially during the 2007 and 8. And what led to it, I think, which we're going to spend some time talking about that crisis per se. But that bubble was, fueled by availability of credit, mortgage-backed securities, and how these branches were the lifeline for a lot of banks to access communities to be able to lend money that they later on repackaged and sold to other institutions. And then after the crisis, obviously, these branches had to close, and some of them, simply the banks vanished or merged, and like we discussed, a great consolidation. And notice how in 2020 and then 2021, the net change of about 3,000 branches compared to the previous year. So, and that's significant. So, there's a truth to how banks use the COVID pandemic as a good excuse to close branches and make an excuse. So, with respect to the reasons of this consolidation, our textbook talks about financial innovation, the shadow banking system, and especially the competition in commercial banking. So, with respect to the financial innovation, we had, with the advancement of technology, a great changes in commercial banking. In fact, when I was in banking about 20 years ago, the credit cards and the debit cards and usage of derivatives and all that were all intact. I think what changed most of it is the electronic banking and the digital currency and what we would refer to as financial technology companies, the blockchain and international transfer of funds. It used to be that from a bank to a bank, as we discussed in class, the only way to transfer money was through correspondent banks and with international reserve account. And today, with the blockchain, institutions have accounts with each other, and so these transfers usually take seconds to execute, and it used to be days and sometimes weeks, depending on which country you're sending the money. So the financial technology also allowed smaller institutions to take part in this innovation and the growth of financial industry. And however, obviously, with this came about bank-like institutions, even though they are not really bank. Like for instance, we talk about PayPal, Venmo, Zelle, and services as such. They're not really banks. However, they do undertake international payments. Perhaps very much like Visa or MasterCard, but a little bit differently in the sense that you're sending cash. So, and then a lot of the times to send cash, you may want to, load some money to your account. So you actually have an account. But they don't offer services like having a branch. I don't think there is a PayPal branch or a Venmo branch. So when we talk about commercial bank, we're talking about a package deal. As part of that banking license to collect deposits, there are some requirements that you have to obey, even though it costs you money. And that comes, the asset management, the liability management, liquidity management, and then the capital adequacy management. And with respect to financial technology companies, we have none of that because they're not really commercial banks. They take money, they transfer money, and basically this is pretty much they do, and therefore they don't expose the banking system to a significant risk, if anything, just payment risk, and therefore they may not be as scrutinized as commercial banks. We also have significant change in how security markets are transacted. It used to be on a floor with a board, but now we have the actual floor and the board, digital boards. But then we have a wholesale market, and then we have the market maker or the dealers that are black box trades or high frequency trading, and then on top of that, we actually have electronic brokerage companies like TD Ameritrade or Fidelity or um, Schwab and whatnot. So, and all of this is possible through the advancements in electronic banking, the speed of internet, and the advancements in hardware technology. Companies like Apple, Intel, AMD having significant progress in processing speed, processing power, and therefore bringing speed to financial transactions as well as security and as well as reliability. So the electronic banking aspect, especially with internet banking, the app banking, but is what we're used to. But above and beyond that, we are now in the era of digital currency, and I don't just mean like cryptocurrencies, but actual digitalized currency. Um, and this actually has a little bit more, um, you know, the, definition differences, if you will, with respect to what digital currency means. But what I'm referring to is how we have access to our money. It used to be cash, and we carry it in our pocket, in our wallets. But then now we have significant credit cards, debit cards, and we can actually make payments with our phones. We could make payments with our watches, and it became so much digitalized that the use of cash is now losing its prominence compared to say 3 or 4 decades ago. So, as a commercial bank, your existence is dependent on electronic banking and digital currency as far as you providing services for your retail client. So there's a little chart here that actually shows the amount of credit card usage to until the second quarter of this year, and this is by LendingTree. And notice how in 1999, this was about $500 billion, and now it's over $1 trillion. And I think that this speaks volumes simply because when we make transactions through this technology that I've been talking about, this actually goes through a credit card usage. And we also seen this volume increase in Visa and MasterCard and other credit card operations. And again, they're not commercial banks, but they're competing with commercial banks for those day-to-day transactions. And everybody is now trying to get a bite out of that fees that these payment processing systems have to offer. So I think one more issue that's significant for us are the securitization and how it actually leads to banking system risk, and especially the mortgage-backed securities. And I want to actually talk about this mortgage-backed security as a financial engineering product. And it used to be, again, that a local bank collects deposits and then use this money to lend out to their local clientele as mortgages or as car financing or business loans. It's the good old commercial banking. A local bank collects the deposits from local clientele and then turns around and lends the money to the same local clientele as mortgages and um, credits, and everybody goes home happy. But obviously, it's not that easy anymore. We have significant competition across commercial banks, national, international, domestic, or local, credit unions, you know. So one of this financial innovation that we have seen is in mortgage-backed securities. So these mortgage-backed securities actually put a lot of banks at risk in 2000, or from 2000 all the way to 2007, 2008, and then when some of this insurance securitization failed, when AIG failed, Freddie Mae and others have failed. That led quite a few banks to lose the integrity of their asset portfolios. And once that failed, quite a few banks had to give up their banking, either filed for bankruptcy or got merged or got acquired. But it actually cost them quite a bit of money. So let's go through what it is. And again, this is part of our financial innovation, financial engineering, and what led our traditional commercial banks into this is the competition that they have to survive, and therefore they may not like it, but they kind of have to do it. So how does it work? And it's actually very simple. So let's say that we actually have $100,000 mortgage, and the idea behind a mortgage is that it's usually a longer term, and you have a house that's the collateral, and therefore, we usually look at mortgages as a more conservative lending practice from a commercial bank perspective, simply because we have the house. You also have usually a multiple borrowers, the traditional commercial borrowers for a mortgage, and therefore, like I said, we usually consider this to be a little bit more conservative lending, and therefore we can actually go for 20 to 30 years. So let's say that we are actually looking for 30 years, and remember we have a collateral, and that's the house. So for $100,000, we have a 30 year. So let's say that we actually did another 100,000. So let's call this mortgage number one, mortgage number two, and then let's do mortgage number three, and let's have another 100,000. And then let's say mortgage 1,000. So let's say this is also $100,000. And remember, what I'm trying to do is, as a bank, I'm trying to create similarly sized mortgages and trying to have similarly risked borrowers. So let's say that for this batch of borrowers, I'm going to go for a credit risk, or the credit score of 600 to 700, no less, but also no more. And based on that, I'm going to charge, let's say, I don't know, 6%. So again, we're explaining mortgage-backed securities. So as a bank, now I have this $100,000 per mortgage, give or take each. And I have about 1,000 clients over all my branches. And this totals about $100 million, right? So everything is great, and I have $100 million of a mortgage portfolio. So what I will do now is every month I'm going to have a a payment. I'm going to receive a payment from each one of these um, borrowers. So let's say that I'm receiving about $1,000. I'm making these numbers up. So I'm going to receive about $1,000 mortgage payment every month. And since it's a thousand, so I'm going to receive $1 million every month, right? Simply, you're looking at these mortgage portfolio, right? And remember, we have one portfolio for this, and we are charging 6% on average, and we want to have borrowers between the credit scores of 600 to 700 for this specific operation. So then what I can do is I could actually write a security, a bond, and I can say that for $100 million of this portfolio, of this, um, you know, I don't want to use the word mortgage back yet, but let's say that we're going to create a mortgage portfolio, and in our portfolio we have 1,000 mortgages totaling $100 million with a borrower's credit score between 600 and 700. And on average, we charge them 6%. And on average, it's about 30 years. So having all that, I can actually also say that this specific product, this specific portfolio earns or receives monthly $1 million. That's your monthly pay. Now, remember, my bank will be handling all the footwork. Our branches are there for this purpose. But as an investor now, you can actually buy a security, a piece, a share of this portfolio and receive a share of this monthly receipts. And your guarantee are, or your guarantee for individual mortgages, guarantees for the individual mortgages are the houses that we put a lien on, they're subject to the mortgage. And now as a bank, I can literally sell this portfolio and try to raise money for this portfolio through selling individual shares of the portfolio. Meaning, even though I actually gave the $100 million, as I actually sell it to individuals like you and I can receive some of that money back, and therefore I can create a second portfolio. I can create a third portfolio. I can create a fourth portfolio. So as a bank, for me, this is great because I'm creating these packaged portfolios where I'm literally giving out mortgages, and that receives monthly payments, and basically selling the shares of these packaged portfolios. So, I could create a second portfolio and say borrowers that are more than 700 in credit score, borrowers that are more than 800 in credit score. But obviously, the higher the score, lower the interest rate. So I'm not sure if people would be interested in that much monthly payment. So there's the cap. In fact, if I were to go a little bit lower than this, let's say the borrower is of less than 500, then I can actually charge, say, 8 or maybe 9%, or even a variable interest rate that changes with the market, which may be easier to market. So I can motivate my branches to sell these higher risk mortgages to individuals to buy houses that they cannot even afford. However, I could make them believe that while they are not as financially viable right now, as life progresses, they will become more viable. And as the interest rates are very high right now, if they take out a variable mortgage interest rate, the interest rates might actually go down, and therefore their mortgage payment might actually go down. And obviously, I have no basis for saying this. I'm just making stuff up. As a bank, I'm actually selling these mortgages and I make you sign a ton of paper that says I'm not making any financial claims. However, in our discussions, I'm basically hinting the idea that interest rates will go down. And I'm a center of, figure of authority, I'm at the bank, I'm the bank manager. And I'm telling you, I think interest rates will go down. Right now it's really high and you're getting 6%, but in about 2 to 3 years, the economy will come down and interest rates will come down. And therefore, there's a case to be made for lower interest rates. And therefore, variable interest rate might be what you're looking for. See, it's a sales pitch. And furthermore, the borrowers with lower credit scores, I can, you know, basically tell them, look, right now in this stage of your life, you might actually have a lower credit score, but as you progress in life, you'll get a better job, you'll have this, you'll have that, and therefore your credit score will go up, and your credit interest rate might actually be renegotiated, and your risk premium might come down, and try to sell you a house that you may not be even able to afford right now, but I can convince you that this is the time to get it, and therefore, in about a few years, you will come and thank me. And again, I get paid by the commission. So I don't really care if you end up paying it or fail. As long as I sell, I get my commission. So, like I said, I'm not saying this is what happened. I'm just saying that there were a lot of news articles that suggested that individual there were individual practices for some banks and for some local credit brokers that have employed such tactics. So anyhow, this setup is usually referred to as a mortgage-backed security. Now, there's a cherry on top, but I can actually do as a bank. While I have this portfolio and I can make the details of the portfolio public or available to investors, I can also get an insurance as to the payments of these individual monthly payments. That this could be more like a mortgage insurance, but not like the mortgage insurance that first-time mortgage takers will to get, but this is more like a credit insurance. So, very much like if you're in an accident and, you have a car liability insurance, the insurance will pay, but what's the likelihood that you're going to have an accident from an insurance perspective? So credit insurance works the same. An insurance company like AIG will actually look at your credit score, your past history, and they can actually provide you with a credit insurance. Now, you don't have to take this insurance on your behalf. In fact, most people don't even know how to. But the banks who are repackaging your mortgage and selling it as a mortgage-backed security can actually get the credit insurance on your behalf and therefore make this portfolio look extra secure. And this, again, for a portfolio where the borrowers have a credit score of 600 to 700 may not be all that big of a deal. But if you're trying to promote a portfolio that has borrowers with, say, less than 500 credit score, then a credit insurance might come in handy. So then the problem again is if the insurance company like AIG goes under, then all of this kind of collapses. So as a bank who have done this and sold it out, you have no issues. You already sold it. So you are basically just taking care of the footwork for these mortgages, providing the services to everybody, providing and utilizing your branches, and everybody goes home happy. But the investors in these mortgages or mortgage-backed securities, mortgage-backed portfolios, now they have to deal with a mortgage portfolio that they thought was collateralized with houses, and they also had individual credit insurance provided by the AIG. Now, coupled by a housing crisis where the house prices, real estate prices went down over a decade, And all of a sudden, the $100 million portfolio, which initially had $100 million worth of houses, now they have, say, $70 million worth of houses. And with the repo and the time it takes and the legal fees and all that, you're looking at about a $50 million worth of houses. And all of a sudden, your portfolio is about 50% collateralized compared to how it started out. And you don't really have a credit insurance because the insurance company went under. So all of a sudden, what you thought was a rock solid investment now doesn't look like an actual a viable investment even. So that's what happened to quite a few banks in the commercial banking system. And this actually exacerbated from 2000 up until 2007. And then when AIG went under in 2008-ish, um, through that process of bankruptcy and then not being allowed and all that. And that led banks who have invested in these, to end up having an asset structure problem or asset management problem. So, one bank packages this and sells it, and another bank actually is buying them. So, as they say, as Chase, if I don't have enough mortgages and I have money, $3.6 trillion of it, I might actually choose to invest in such mortgage-backed portfolios of securities. And when the security becomes loose or loses its collateral's value, then my asset structure becomes risky. And I have to set aside reserves, and my assets just became riskier. And if I'm a small bank who just happen to invest in this because it's cheap, it's easy, and it actually provides a good return, now I'm in trouble. And a lot of banks actually went under because they invested in these variable interest rate mortgage-backed securities that were insured by AIG. And that was quite an ordeal that we had in 2007, 8, 9, all the way up until 2010, when Fed created a bad loan company and literally bought these mortgage-backed securities from some of the commercial banks, literally, and that and most of them on the full face value, and that actually provided a significant relief to commercial banking system. So anyhow, for Friday, we're going to be talking about why the banking system needs to be separated from the financial services. Why can't you just buy insurance from a bank? Why can't you have investment services offered by a bank? And also, we're going to talk about the Basel banking regulation internationally, and then we're going to talk about some very local banks or credit unions and how they still are able to survive, considering all this complications with financial engineering and competition that technology brings and the cost of financial security, reliability, and the electronic safety and whatnot. So again, thank you for working with me. I really do appreciate you. And please let me know if you have any questions. And thank you. Have a great day.